is the valuation, where we have seen a lot has changed over the last 1 year. Now, just take a case of 10-year bond yield, which was closer to 6% last year, and now we have bond yield closer to 7.10, which is more than 100 basis point jump in bond yield, despite RBI maintaining status quo on policy rates. So there we have some comfort. Bond yields have already discounted some of the rate hikes. From the historical valuation perspective, if we just look at the spread between the 10-year bond yield and the repo rate, currently it's 300 basis point. Now, if you look back, the 20-year average of this spread is closer to 80 basis point. So much of the monetary policy action is already discounted. But will the future path will be smooth? No. Probably we'll have very volatile market going forward. Particularly from this demand supply situation and all the global uncertainty that will create some volatility in the bond market. There will be pressure from domestic demand supply issues, which can actually push the long-term bond yields even higher from current levels. So we should expect some rise in bond yields over this year, but it won't be that much. Probably we'll see another 25-30 basis points rise in bond yields, and probably there it will find its balance. Rising bond yield is negative for debt funds, but impact is not same across the all debt fund categories. Especially at the shorter end, when bond yields move up, they tends to gain, especially funds like liquid fund or even the money market funds. There you see their performance improving as RBI starts hiking rate. So they tends to gain. While at the longer end, there is a lot of uncertainty. We may see long-term bond yields moving even higher, or there will be high volatility. That can create a lot of turbulence in the long-term debt fund space. But yes, overall return potential has improved across the various debt schemes. As I said, much of the rate hike and the inflationary pressures are already priced in at current yield levels. So there is an opportunity. Return potential has improved a lot over the last 1 year. But for conservative investors who can't tolerate the ups and downs in their NAV or the high volatility of the market, or they have a shorter time horizon, it's better to stick to short-term debt categories like liquid fund or money market fund. For investors who have slightly higher risk appetite and a longer holding period, at least they can hold for more than 3 years, I think dynamic bond funds are very well positioned to gain in this kind of environment.